the general stuff that most people should be claiming with a rental property is around your insurances, your maintenance, your property management fees, reviewing any of those repairs and making sure they are repairs. Borrowing, look, the trust is a really effective way of increasing your borrow capacity if it's self-sufficient. I mean, what that basically means is that that property is positively returning money. It's not requiring any money to keep going. I think probably the most important thing is to get in touch with the right advisors and have a plan.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
So, welcome back to the podcast, Ash. You're my favourite accountant. Thanks for joining us.
Thanks, Jared, mate. Good to be here.
I thought we'd get you on to talk about some of your top tips to boost your bottom line at tax time. And you might ask as a listener, well, Jared, why didn't you bring me this episode a month ago? Valid question, perhaps. But what I find with tax is that everyone runs and has a scramble in the last, 2 weeks before the end of the financial year. But a lot of the things you actually need to have a bit of planning around them, have things sort of set out during the financial year so that by the time you get around to the end of the financial year, you've got everything in order, you've got everything set up, and you can maximize your actual tax return at that sort of time. So I thought it'd be a bit counted timing wise and get it out now.
Oh, look, I prefer it on this side of the year. It was a little bit hectic, 30 June.
That said, yeah, I probably couldn't get any accountant on the podcast a month ago with how busy they would have been.
But you're right. Most people are putting their documentation together now, and there's certain things they can do now and be better prepared for the future years by listening to this with the right frame of mind instead of trying to rush for that 30 June deadline. So I'm actually all for early in the financial year to address these things.
And I like to think of your overall tax planning a bit like running your business. It's your property business, isn't it? And if you want to get as much out of it as possible, and I just did an episode with Dwayne, who you know, on the top tips to boost your returns from the property management side. And now I thought, we'll go into the top tips to improve your returns in this taxation side. And it's really a case of, running your business tightly, treating it like that, and being a bit more professional how you go about things, and then that way you're going to get as much back as possible, and it's probably going to decrease the stress for you as well, because there's nothing worse than having everything all over the place and trying to prepare for a tax return as well.
Oh, I think you've hit the nail on the head there. If you know your numbers and you know your business, you're okay. There's no surprises. It's the last minute flinging around trying to figure out what the tax bill is or what the return is that. Why haven't you asked? Why haven't you done this beforehand? And if this was a serious part of your plan, you'd probably want to know where you're standing at any given time. So, whether it's once a month, whether it's once a quarter, every 6 months, it should be scheduled in to do the review just to keep an eye on how things are going. So, I think that's a great way to start.
Let's go into your first tip on sort of start with some general ones, and we can get a little deeper from there, perhaps.
Yeah, look, I suppose, the general stuff that most people should be claiming with a rental property is around your insurances, your maintenance, your property management fees, reviewing any of those repairs and making sure they are repairs. And we'll get into a bit more deeper around the depreciation with the second area, but it's just going through and collecting all of those receipts and records. One of the things I strongly advise people with property managers to do is actually send as much information as you can to the property managers, because they put this awesome year-end report that has everything in there. And if you're not sure, it's been itemised there, and it's a great starting point for us as accountants, and property managers have got those records together. It's a little bit frustrating when we're doing the tax work and property managers only got some of the stuff and we got some of the other stuff here, and we don't have a full picture. And it only happens to be at that time when we prepare the tax return that the client finally understands what their return on the investment is, opposed to if they actually had everything with the property manager, they would have either seen the statements regularly, they would have seen the income and exits cash flow wise. They'd have a good understanding of what this property is actually making for them cash flow wise. So I'm a big believer in sending as much as they can to a property manager and utilising that service, because that's what you guys are great at, and you want to be able to give that information, and it's hard for you if you don't see the council rates or the strata fees or all these bills because people can't be bothered forwarding it or keeping records of it there.
I mean, what often happens is something doesn't get paid, and then the landlord realizes just how important keeping on top of those things are. And of course, it happens right when we go to make an insurance claim, we and the tenant get a notice that council rates are unpaid, and they're giving final warnings on stuff. And so, yeah, your property manager can handle all of these kind of payments. I, for my interstate properties as well, get my property managers to handle everything, and even the ones that I put through here, I get them to basically do everything. The only ones I struggle with is I keep the building insurance policy out, and I just know that with all my properties, I send across the building insurance amounts at the end of the year, and that's the sort of the harder one that's often direct debited if you don't want to pay a bigger lump sum, and it's harder for them to invoice your manager, and I like to ensure that gets paid because it's probably the biggest consequence if it doesn't.
That's fair enough. But that's a great process. You've identified everything that can go and what you want to keep in your house, opposed to some people, and you probably come across it in your experiences where people have got a property manager, but they're only got half the invoices going through that process, when really vast majority could come through the right team.
Definitely. Cool. So I guess just making sure that you claim all those eligible deductions, having them all in one place, as you said, is a fabulous starting point. And I guess realizing that pretty much every expense associated with your property can be claimed, so it should be in there.
Yeah, look, and if you're not sure, ask the question, right? So there's some, look, travel got removed quite a few years ago as a deduction, but
yeah, that was a bummer, wasn't it?
Yeah, it was a bummer for a few people that had properties that they would go and inspect.
People stopped buying in the Gold Coast to get their tax deductible, annual trips to Movie World.
The Movie World and check the place out. Look, and that was probably one of the reasons those things got removed. But look, valuably, for some people, they actually did travel to properties interstate to inspect, and they can't claim that deduction anymore. But asking that question is important. So I'd always err on that side of asking and then putting it through. So,
okay, cool. So in terms of going a little deeper into the other types of ways to save on your tax, what else you got for us?
Look, I think the one that gets a little bit complicated is around the depreciation, and there were some changes, and it's going back almost 7 years ago, where you couldn't claim depreciation on plant and equipment. And I've got to be really clear, it's on the plant and equipment of a property that's already been used. So some people have made the honest mistake thinking there's no depreciation left to claim, but capital works is still around. And to be honest, capital works is usually one of the biggest deductions available for the property. But to be sure, you engage a property surveyor to do the report, and that they'll outline all the items that can be claimed for your rental property. And it's really important to get that report. So while it might cost a few $100s or even up to $600 to get these reports typically will pay for themselves in deductions, depending on your income rate, but they're also tax deductible themselves, the fee itself. So really important to do that. As a result, don't use the depreciation report that was used by the previous tenant, because it will have items in there you can't use. So always go get a new report. Just like we would say, look, most properties are going to cost you in excess of $500,000. Spending $500 to $600 on getting a report is a small cost in the big scheme of that investment. So it's just one of those costs that you've got to probably make the right decision and get that report. The alternative is to get an accountant to try and prepare that report, but I'm not sure about most accountants, but our hourly rates will outweigh that report quite quickly. And again, we would need all the receipts and itemised for us to do it, opposed to a quantitative surveyor to go and do that report, and usually has historical evidence to help them prepare that report.
Yeah, good point. And I know there's a few of the depreciation schedule creators that basically have a guarantee that if you're not going to make it back in the first year, then they don't go ahead, or they don't charge for the report, or they do an assessment to begin with to see if it's going to be worth your time, worth their cost rather, to get it back. So
yeah, look, we're all in this industry to provide value services. So if they can't feel like they're doing it, then that service does make sense. Look, I think it'd be very surprising that it doesn't pay for itself for most properties, unless it's a very old property that has nothing done to it for quite a few years. In the good old days when you could probably build a house for $30,000, Jared, I don't think you could get a carport, let alone for that sort of price now.
Well, your capital works, obviously, for most buildings that are more than 40 years old, if they haven't had, as you say, a substantial renovation done or a carport or a patio or, any sort of major work done to it, then it probably isn't going to be worthwhile. But I'd probably leave it up to the experts at the quantity surveyors to give you some feedback and decide if it's worth.
That's what they're there for. Yep.
Awesome. So what would be your next tip?
Look, there's these, they're quite popular a while ago. It's called prepaying some of your expenses. So expenses that you would incur naturally, you can pay ahead of time. And obviously the easiest one and most affordable one is usually around insurances. And given the environment where insurances have obviously gone up significantly at places, prepaying that insurance bill a year ahead basically brings forward that deduction in your rental property.
Well, it's probably one way you could get your manager to pay it, just have them do it in a lump sum and might hit you with a 2 weeks or 3 weeks rent, but at least then it's captured and it's in there and you probably get a nice discount for paying it ahead too.
It's great use of that of an expense you're doing, but obviously, you want to make sure that you're going to be having that property for that period of time. Obviously, the more advantageous, but obviously more costly one is prepaying interest. And that's a really possible one to do. Obviously, engaging your banking team or your finance team to ask that provider what it would cost to prepay rent for a year. Usually there's a price also associated with that because that's them factoring what they think will happen with interest rates for the next 12 months. And prepaying the interest can obviously reduce the taxable income from that rental property by doing that ahead of time. So nothing wrong with doing that, but obviously you then you have to keep prepaying the interest each year. Otherwise there's going to be a year where you won't have an interest deduction. So you've locked yourself into that cash flow situation. But for some people, that's a really effective strategy of reducing it. Probably the other one that I sort of missed before was around borrowing expenses. So there's items that associate with purchasing a property. So the loan establishment fees or any stamp duty on that establishment, all of those costs can be apportioned over 5 years of the property, and sometimes they do get missed.
I didn't realise that was over 5 years. I thought it was added to your cost base, so that's a good one for me to know.
No, so those ones do. It's obviously stamp duty itself, not. That's part of the cost base, but stamp duty on the registration of the insurances or the establishment fees or valuation fees.
How's the buyer's agency fee treated, just to put you on the spot?
It would be a capital item because it's part of the acquisition cost. It would go on the capital, unfortunately. Look, if you're in the business of property, potentially it could be a business expense. If you're in the property development and it's around that side of things, it would probably be looking at a business expense, but you've moved from investing to a developer.
More on income and not your capital offset. Cool.
And probably the only other thing, obviously you do have some investors or podcast listeners that are commercial properties. The changes that happened in 2017 for capital assets doesn't apply to commercial properties. So
sweetening deal for commercial property investors.
Yes, they made sure they looked after commercial properties and business owners when they did make that change in the 2017 budget.
I only just realised that. So there's certainly a few little advantages adding up on the commercial side for investors. And yeah, I guess that's another one.
There's another one there with the depreciation for sure.
Awesome. So why don't we go into some slightly higher level stuff, looking at structures and losses. Do you have any sort of tips around those areas?
Yeah, look, there's definitely, I would say it's really important to have a plan before we go down this structure rabbit hole, so to speak. It's when people have a plan along with their finance and their advisor team and with buyers agents is understand what this plan for this family or person is, and then understand where that structure sits. There are times when people will go with a certain strategy, but not understanding what the costs and the ongoing benefits are, and then realizing too late that it's very hard to get out of this map, so to speak, or plan because it wasn't cultured in the right environment of understanding the purpose. So I'd start with that point, but for most people, it could be in both, a husband and wife partnership, owning in joint names. It could be in one person's name that's on a lower income, depending on the yield and negative gearing, or it could be in a family trust where you sort of get the best of both situations where you can control where the income capital goes, but the income's in the family trust. However, if it's a negative geared, you've lost that capacity because it's negatively geared. There are somewhat other strategies with super, but it all comes back to that understanding the purpose and then coming up with the right structure to suit that person. But whole in all those structures work really well with all different family groups. It just depends on the number of properties and what the plans are in terms of accounting fees and legal costs and maybe extra finance costs for having these structures. It's important to understand all of those things before going down a pathway, because some people, might go with a really simple strategy, but their ultimate plan is to have 4 or 5 properties, and they've either, cost themselves in terms of borrowing capacity by going down that pathway, or alternatively, they've created a potential tax problem because they've gone down a pathway of borrowing against the highest income earner in that structure. So I think it's really important to understand the why first, and then the structures can come. And the unfortunate part in Australia is to change structures is very costly because of stamp duty. If stamp duty didn't exist, it's not really a big issue. Well, capital gains always exist, but the stamp duty hit is that physical hit that just for, owning an entity can cause unnecessary stress. But there are ways around that as well. So if you've got the right laws, you can apply for nominal duty, which is a totally different can of worms, but that can be achieved for certain people transferring properties from husband and wife into a trust.
You get that structure wrong, I guess, and the benefit outweighs the potential costs to change it.
Yeah. So look, I think I'm happy to start with how a trust works and what the pros and cons are for the listeners in terms of what that advantage has, because it's probably been, I was listening to one of your other podcasts about borrowing. Look, the trust is a really effective way of increasing your borrowing capacity if it's self-sufficient. I mean, what that basically means is that property is positively returning money. It's not requiring any money to keep going. And as a result, it's its own entity. So it's probably left separate to your assessment as a borrowing capacity for that bank. So all of those sort of things are really positive. However, the things you've got to make sure is if that property turns into being negatively geared, i.e., you can't find a tenant for a period of time, or interest rates rise to a point that it's now negatively geared.
Most of us were probably fairly close to neutral and are now in negative territory.
Yeah. Unfortunately, with where things are with the RBA at the moment, that's where we are until rents increase a bit further or the rates drop. And as a result, if you're in that negative loss, you've just got all this negative income sitting in that trust. Now, that can be used up in future years when you sell the property and hopefully make a capital gain, but you've lost that borrowing capacity, or you've lost all that in tax deductibility there. So while some people might be really focused on the negative gearing, which I know we're going to get to a bit later around, you could claim that loss against your income, and your income tax rate might be higher than the spouse. So you might be really focused on that, reducing your tax bill by buying a bunch of properties against the high income earner's name, so to speak. So,
and the negative gearing won't be forever, of course, and it might just get you through that first 5 years, when the gap's the biggest.
Exactly. So, yeah. And I think that's what people sometimes forget, Jared, is like the negative gearing might be the quick fix or the Band-Aid now, but then all of a sudden you've got positively geared in the high income earner, and you've got the capital gains trapped with that person. So all of a sudden there's a lot of negatives against that initial strategy. So it's just understanding what's this property for, how long, what's your, when do you plan on exiting? And if all of those things line up to what the plan is, well, then it's okay to accept it. But, I think that's the importance of having a plan.
Well, the other one I've been thinking more closely about is land tax, because, as you accumulate more properties, you cross, if it's all in your joint names or in the same name that you're acquiring them, and you're not using structures, then not only can it add up today to a bigger land tax bill, but in the future, if your property's double, triple, quadruple by the time that you're retiring, dare I say, that's going to be a fairly hefty land tax bill down the track too.
Yeah, state taxes are another beast all by itself. And land tax and structuring is really important if you're accumulating a lot of property in a certain state. And again, sometimes the cost of actually having the structure saves you the thousands that you might be paying in land tax. And we've definitely got a couple of clients that have set up entities in their separate structures just simply because of the accumulation of land tax, because it's not a flat rate depending on all properties, and they don't look down who the beneficial owner of the trust is. They look at who's on the title. And ultimately, that's the key part with land tax, unfortunately. Look, again, hopefully that simplifies in the future, because it does seem to be proportionally unfair, in my opinion, how it's structured at the moment. Because, again, by having separate entities, the owners haven't changed, but the tax rate has. So it doesn't really seem to have the objective of what the land tax was really about, which was just the cost of having land. And most people are going to develop that land to provide housing. So that seems counterintuitive to what the tax is for. But again, probably not the right place to debate the merits of a tax. But again, you can structure correctly.
Well, I guess it comes back to purpose, like you said. And if you start layering some other things that you just touched on then, of you're going to develop the site potentially, then that's probably another purpose factor to consider as to when you develop it, you're more likely to be in the positive cash flow territory. You're probably going to be taking on a bit more risk as well going through that development, that you might want some shielding to not expose you to in the personal name side. And I guess it's just putting all these factors together, weighing them up with your accountant that understands the whole picture. And that's why I've always found you to be great with going to the purpose at the core of it.
Yeah, ultimately, us accountants are really great at creating a spider web of entities, but we like to understand why we're doing it, because when we have to cut those legs off, it's painful to close those entities off. So the purpose is really important. And if people know, oh yeah, this entity was there for the potential development and land tax and separating the entity completely, then when we pay those costs each year, we understand that those holding costs are part of the investment overall, and it's a cost, opposed to, I don't know why this was set up. Why am I paying $2,000 or $3,000 a year? Don't understand it. I'm just going to close it. And then after they realise the cost of closing it, it's like, it's too hard, and why did we do it in the first place? So I always like to understand that first.
Well, I'll put a link in the show notes to our expanded episode where we did talk about structuring a little while back, and people can go listen to that for a bit extra input on things, and they can obviously reach out to you if they need a good accountant. So I'll put your details in the show notes. Now, I don't want to just brush over. I mentioned negative gearing, and we probably shouldn't assume that every listener knows what that is. Can you just give us a good layman's accountant definition on that?
Yeah, look, I'll show you. The really simple way of explaining it is you might have an investment in the same sort of property, so it's got rent, has generally the income coming through, and let's just say it's $20,000 a year. And the cost of having the rental property, including property management fee, interest, insurance, etc., is $25,000. So effectively, you're out of pocket $5,000. That's your deduction. Where properties have that extra potential deduction is around the capital work. So if there was a building improvement of substantial amount, there's a 2.5% deduction on that original capital works amount that comes off. So all of a sudden there might be, let's say, $3,000 worth of capital works. Well, now you've got an $8,000 deduction against your income. If it's in one name or if it's in two names, you split obviously the loss amongst both of you.
So that carries across against our other income from our job if it's in joint name or personal name, yeah.
Exactly, yeah. So if your income rate happens to be, earn 120, well, now you've just got a $8,000 deduction against that 120, so you're paying tax only on 112. So it's a deduction as such, and there's various other concepts around that. It's just a general tax law of any costs associated with that income can be deducted in the ordinary course of it. So that's where generally most of these deductions will fall under. So
I wonder why they came up with the word. The negative part's obvious, that you're losing more money than you're making on the property, and do you know how they came up with gearing? I've always wondered.
I would say the gearing is in terms of leverage. So you're leveraging against the property value. So you're gearing your negative income here and hoping for the upside in the value. So I think that's where the gearing is in reference to. But again, that's a good question. I should actually, I might ask Alexa afterwards. we probably send me to a mechanic, but we'll look into it.
So continuing on with some more advanced considerations, what have you got as far as capital gains tax planning down the end future, whenever you get to that point? Because, yes, you may hold your asset forever, and if you do, your capital gains tax that you pay is zero. But if you're going to sell, and we don't always, you might plan to hold it forever, but sometimes life's events get in the way. You might need some cash. You've got a lot of it tied up in your properties. You might want to, some people I'm finding I'm selling to help them transition slowly to retirement. So they might sell a property here, wait a few years, sell another one when they, need to. Others selling at the moment to upgrade their homes. So you might have intended to hold it forever, but if that enables you to upgrade now instead of waiting another 2 to 3 years when we've got more growth ahead in the upper market, upper price points, then it definitely does make sense to take your gains on your lower price property because they've done really well over the last 2-3 years, upgrade into something before the price points increase as much in the upper end. And yeah, lots of people sort of in that boat as well. So
yep. No, there's a lot of people taking advantage of the market and what upsides they might have in the future. And again, that happens all through the life cycle we'll have. All intentions and all plans do change. But from a capital gains point of view, and I've probably helped a few clients in the last pre-30 June, it was always, these were a few of the clients in the rush where they've sold some properties during the year. They paid, they expected capital gain, let's say was $100,000 or $200,000. Actually, I'll use one couple made $200,000 on a property. So it's $100,000 each would be assessable. You get that 50% discount because they've had the property for more than a year. So it's $50,000 each. That's after adding back the capital works, which is the depreciation we claimed in previous years. So let's just make it really simple and say $50,000 each. And they're like, well, how much tax are we going to pay, Ash, on that 50? So there's two options. We can pay tax at your nominal tax rate of at $50,000, which was roughly around, I think it was around $20,000 each was maybe what they were going to pay. Alternatively, they could take advantage of a change that happened a few years ago where you can put extra money into super. So you can put extra money into super if your balance is under $500,000 and in that previous year, and you hadn't used up your maximum super contributions for the previous 5 years. So they had enough in there, and both parties put in what they could to reduce that capital gain amount. So when they pay tax in their super,
I actually didn't know about that one.
Yeah, so they put the money into super, reduce their tax bill, their personal name. Obviously, they're paying tax in their super fund, but now their super fund's got a big shot in the arm, and now they'll look at what they do in their super fund. So they're continuing with their current super funds. But
so would you pay 15%?
You will pay 15% if your total income after income test is under 250. So if you happen to go over 250, you'll go in at 30% on those contributions. But that still was lower than their normal tax rate. So it's a win when you have those big capital gain events to make advantage of that super catch up if you've got under $500,000 in your super funds all across Australia. So really clever tool.
So is there anything else in the sort of super space that we can look at to try to minimise tax? And I know we did an episode on super way back too, so we'll put that one in the show notes.
Yeah. Look, there's a few other ones in terms of super offsets, spousal offsets. So you can put a little bit of money to reduce your personal tax by contributing money into your spouse's super. Look, it's not a huge deduction, but it's available there. Probably the biggest one that's sort of not spoken around is around first home owners. And these are for all those young listeners that you've got, Jared, or parents potentially talking to their kids, is putting money into their super, into the first home owners saver scheme. By putting that money into their super fund, they will be able to access it on certain conditions for the deposit of their first house. So the money will come out of their super fund. There will be some tax on the money coming out, but it's at a nominal rate. And they've got the tax deduction for putting the money into super. So once you've got that first job and you're obviously earning more than the tax-free threshold, and you're thinking about it for your first house, this is a great little tool to put money into your super fund. You do tell them that it's for the first homeowners scheme, so they know that they're setting it up for that purpose. And that fund will run through the conditions of release. And it's a really clever way to do it. And, we've educated a lot of our clients of that ability, and it's a way that helps reduce their children's tax bill when they're earning full-time wages, but also then allows them to get that money out for an eligible house. So really great initiative. If they can't release it because they don't meet the conditions, or worst case scenario, their money's in super at an early age and it's going to compound in and have a great return for the child in the end. So really, really great initiative by the government to have that in place.
Just thinking out loudly here for the business owners and or people that have a trust structure and their kids start getting a bit older, doing a few things to help and receiving some remuneration through those structures. Like, is this something that you can pay through that way?
Yeah, look, obviously pay kids whatever the wage should be for what work they do in the business. The ATO has come pretty strongly on trust distributions to kids. Adult kids can happen if you transfer the funds to them and there's a purpose.
Yeah, I'm really thinking over 18.
Over 18, yep. Over 18, if you distribute the funds to them, again, it's one of those things that the ATO has flagged, but if you distribute the funds to them, they put the money into their super, definitely a great benefit for them. It'll be part of their strategy.
I'm just thinking it might be a way to sort of help them out while also having them be involved in either your business or in your investing.
Definitely will probably fit into some people's structures, but again, just wary of the ATO's trust distribution guidelines.
Don't want to hit the red flags.
Do not want the red flags. Stay in the green.
Awesome. So we've ran through a fair bit today, starting with the more basic, general, get your house in order type stuff, going into depreciation, going into more of the advanced sort of loan structures, prepaying expenses, and touching on a few other super related things, which I hadn't even heard. So any final tips to leave us with, or have we hit all the main marks today?
I think we've hit most of the main marks, but I think probably the most important thing is to get in touch with the right advisors and have a plan. So if you as a family or you as a person sit down and go what you want out of your property and your investments, it makes it really easier. It makes it a lot easier for advisors around you to give you the right advice for your circumstance. I think having a plan and knowing what you want makes it a lot easier for all of us. It's when people I want to do this, but there's no why. It makes it hard to get them on the right path, because you can sort of feel like that's going to not be the right structure for that person, but they're telling you that's what they want, and that's probably the clarity. Is just if they're really clear on it, then it makes it really easy. And I'm sure you find the same with property investors and in the buyer's agent space as well, as when people are really clear on what they want, they're the clients that are easy to navigate with and negotiate for.
We find if we spend the time doing a strategic plan up front and getting super clear on those goals, then the actual how we implement it is so much easier for everyone, and we can just look at, okay, here's where we're headed, and then keep reviewing and making minor adjustments along the way instead of, major changes that are often very costly that you spoke about. And yeah, if you can get set up right from the start, that's best. But, we all make mistakes and sometimes things need unwinding, and I certainly didn't get structured or set up right from the beginning either. And it's only when you start getting a bit educated and start getting the right team around you as well that you can get things right. So don't also kick yourself too much if you've made a few mistakes. And because any of us investors or business owners that have been around a while, we've all been there.
Jared, I'm an accountant and I've made mistakes. We definitely, but it's how you learn from them. And I think the key part is what you touched on there. It's the team. If you meet the right people, all of a sudden things seem to make sense, and the plan will come to fruition. But yes, we have to learn from those lessons. I put my whole business plan on a tax legislation that never came to fruition. So I knew everything about the carbon tax, Jared. And for any of those older listeners, the carbon tax never came around because we got rid of 2 prime ministers. So I had a whole knowledge base that is not useful in any shape or form, but that was the original business plan. So look, we all learn.
Well, thanks for coming on the show today. I'm sure there's lots of great insights for listeners there, and I'll put your details in the show notes. You're at Eventum Group, and awesome. First place to start is to chat to you if they don't have a good accountant at the moment. So
I appreciate that, Jared, and thanks for having me on. Look forward to catching up soon.
Cheers, mate.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group. to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.